Good morning, everyone, and welcome to this month's Pro Power Hour. My name is Grant Chapman, and I work in the advisor marketing team here at Intuit QuickBooks, and I'm your host for today's session. It's great to have you join us today. And before we begin, I'd just like to pay my respects to elders and the traditional owners of the land on which we meet today, the Gadigal people of the Eora Nation, where I am here in Sydney, and pay my respects to elders past, present, and emerging. In today's Pro Power Hour, we're going to take a deep dive into the federal budget, looking at some of the issues that you need to have on your radar, some of the trickier measures that were announced, and some of the ones that offer some opportunities for your clients. Before we begin, it's likely that everyone on the call today is aware of Intuit's flagship product, QuickBooks Online, given that it's used by more than 300,000 accountants and bookkeepers and more than 7 million small businesses around the world. Importantly, it also includes a number of features that only accountants and bookkeepers can access to help you power through working with your clients' books. They include Books Review, Prep for Taxes, and QuickBooks Tax, which I'll touch on later today. There's also our leading payroll solution integrated with QuickBooks Online that makes sure your clients' employees are getting paid on time while making STP and ATO compliance simple. Then we have QuickBooks Online Accountant, which helps you manage your practice as well as your clients. It helps you keep on top of your workflow, manage your projects and tasks, track your time and billing, and more. On the compliance front, QuickBooks Tax, powered by LodgeiT, is a really powerful online tool to help you manage your tax and BAS preparation and lodgement needs. One of the key features that makes QuickBooks Tax unique is the ability to import data from various accounting systems, not just from QuickBooks Online. So it actually works for all of your small business clients. So stick around. We're going to take a look at a couple of those tools that can streamline your end of financial year processes after we dig into the budget today. Right, so before we start, just a little bit of quick housekeeping for you. So today's session is being recorded, and we'll have a recording of the session out to everyone who registered by email. If you do have questions for the end of the session today, just make sure that you use the Q&A component in the Zoom window there, and we'll get to them at the end of the session. If you're having any technical difficulties with not being able to see or hear the presentation, we'd suggest you restart your device, refresh your browser, or try a different device. Again, you will receive a copy of the recording of the session, so while it's not as good as the live thing, there's no need to panic that you'll miss out on anything. Okay, with the housekeeping done, we will jump into a quick introduction for our speaker today. So today you're going to hear from Robyn Jacobson, and Robyn has been a voice in the accounting profession for nearly 3 decades. For more than 20 years, Robyn's been guiding the profession in her role as a professional tax trainer following her formative years in public practice. In her role as senior advocate with the Tax Institute, Robyn really champions improvements to our tax system with a focus on SMEs. She regularly engages with the Treasury, the ATO, the Board of Taxation, the Inspector General of Taxation, the Taxation Ombudsman, and the professional bodies on technical issues, really cementing her place as a voice for the profession amongst practitioners, professional bodies, and with regulatory and government stakeholders. Robyn's a chartered tax advisor with the Tax Institute. She's also a fellow of both CAANZ and CPA Australia, and is a registered tax agent. Robyn's a social media commentator, a columnist, a blogger, a webcaster, and a regular presenter on tax legislation and policy issues. Today, Robyn is going to look at what those measures in last week's federal budget mean for you and for your clients. Okay, I'll be back at the end of the session, but now I'm going to hand it over to Robyn. Thanks.
Thank you, Grant, and thank you to Intuit for this opportunity to speak to you about the federal budget. So it's great to be with you to discuss all these measures. Just a few points to kick off with. Due to the amount of information that I'd like to discuss with you versus the time constraints, there are a number of hidden slides throughout the presentation, but these will be provided to you in your slide pack, which will accompany the recording of the session. There are a number of hyperlinks throughout the slides, and when you click on these or tap on them, they will take you through to further information once you get your electronic version of the slides. I'm a big user of abbreviations, given all the acronyms we have in tax law, and there is a table at the back of the presentation that contains a list of all these acronyms and exactly what they mean. Finally, as I've said, and as Grant has said, the session is being recorded. I tend to move at a fairly fast pace, so if there's anything you do miss, you can come back to the recording. So the figures to begin with, this is the key economic data that was released in last Tuesday's federal budget. So I'm going to start with the top row. Now, in the accountants world, we call this the profit or the loss. The media calls it the surplus or the deficit. The government calls it the underlying cash balance. And this is going to obviously set out in the years ahead, what's called the forward estimates period, what the budget's going to look like. Extraordinarily, we are headed for a surplus for 22-23. That's probably the biggest surprise that I found in the budget papers when I opened them up. There was certainly talk in the media in the days and week or so leading up to the budget, but I interpreted that to be a potential surplus in 23-24. But in fact, it looks like we'll be in surplus for 22-23. It's been almost 15 years since we've had a surplus. The last time was 2007-8. But it's important to keep this in context. The surplus is generally expected this year because of very strong commodity prices. And also with inflation, that pushes up prices and that pushes up income tax and so on. So in terms of those receipts, that's ostensibly where that growth is coming from. But you'll see in the years ahead, it's going straight back into the red. So we will know the final outcome for 22-23 around September this year. But given all the spending measures that are included in the budget, it is expected to be deficits for many years to come. Now, CPI, the inflation rate, it'll be interesting to see if the forecast is achievable. They're predicting 6% for this year, which has certainly come off the higher rates we've seen over the past 12 months, certainly more than 7%. But 3.25% is what they're predicting for 23-24. Now, that's a big improvement, and it starts to head back to the Reserve Bank's target range of 2 to 3%, but let's see whether we get there. The gross debt, media is reporting that we're paying around $60 billion a day in interest, and that's with low interest rates. That's because our gross debt is now very high, and you can see it's tipped to exceed $1 trillion by 25-26. Now, this isn't surprising, and it's not necessarily a bad thing as long as the spending is targeted to the right areas. Wage growth, you'll see the third from the bottom, has trailed behind inflation for a while now, and it is placing many people under pressure. So let's see if we can reverse this trend in the year ahead. So personal tax and superannuation, it was very much expected that this budget would focus on the cost of living pressures. And understandably, this budget has sought to assist those most in need and those who are most vulnerable. So it's really good to see investments in Medicare, improving access to GP services, as well as support for the NDIS and the aged care sectors. There wasn't a lot in the budget for middle income earners. And the challenge for the government here is that if relief is provided to middle and higher income earners, although they may also be struggling, it would be counterintuitive to the government's objective of trying to lower inflation if support were provided to that sector, which of course enables them to go and spend more, which increases or puts pressure on inflation. So there weren't a lot of individual measures in the budget. The two primary measures dealt with amendments to the Medicare levy low income thresholds, and that's an annual increase that we see each year. So that will be in your hidden slides. And also they're going to be carving out lump sum payment in arrears from being subject to the Medicare levy. So I'm going to leave personal income measures there for the moment. Let's get into the superannuation space where there were some more significant changes. Firstly, the non-arm's length income provisions. So in the budget, it was announced that there will be a series of technical amendments to these provisions, which tax non-arm's length income at the highest marginal tax rate in the super fund. Now, a previous discussion paper had proposed that there would be a limit on the amount of income that a self-managed fund and a small APRA-regulated fund would be subject to in terms of its NALI income. And that cap was going to be 5 times the amount of a general expense. They're now going to legislate to make that a 2 times multiple. So if you've got a general expense, you take 2 times that expense, and that is the maximum amount of income that could be treated as NALI. This is a big improvement on the current rules because you could have, say, a $100 discount on accounting fees in a self-managed fund, and that, as it currently stands, could disproportionately taint the entire income of the fund because the accounting fees are taken to relate to the super fund expenses generally. They don't pertain to a particular asset. It can also taint future capital gains. So it is pleasing to see this amendment being proposed. There's also an announcement that they will ensure that fund income that is taxed as NALI will exclude contributions. Now, we're still trying to understand exactly what that measure means. It can be interpreted a number of ways, so we are going to wait for the detail on that one. They're also going to exclude large APRA regulated funds from the NALI provisions for both general and specific expenses of the fund. Now, when I say specific, I'm referring to expenses that are specific to a particular asset. So you might have rental property deductions that relate to the rental income of a property, whereas a general expense would be more like administration fees or accounting fees and the like. So they will be exempted from the NALI provisions. The previous proposal was that only general expenses would be exempt from NALI. So these changes are significant and they're a big improvement on the initial consultation. There's been extensive consultation for many years, and we're really pleased that consultation has resulted in this change. But it's uncertain whether the broader underlying concerns raised by the professional associations, including the Tax Institute, are going to be addressed. So the devil will be in the detail, and we look forward to seeing these provisions in an exposure draft form. Moving on to the additional 15% tax on superannuation balances over $3 million. Now, this is proposed from 1 July 2025. This was previously announced, so there was nothing further in the budget that we didn't already know. We know that the earnings on superannuation balances above $3 million will be subject to an additional 15% tax. It will be imposed on the individual member, a little bit like Division 293 tax or the excess contributions tax, but there'll be an option to be able to withdraw this from the super fund. They are still designing how the measures are going to apply to defined benefit interests. They are, of course, much more complicated, and that is still to be determined. So we wait to see the detail of that. In terms of how this is going to work, the first assessments are not going to arise until 26-27. And that is because the law will need to run for a full year from 1 July 25 to June 30, 2026 to enable the earnings for that year to be calculated, and then the assessments will be issued in the following income year. Now, the primary concern which has dominated discussions and debate, and certainly has been included in our submission to the Treasury, and that is the taxation of unrealised capital gains. We do not support this as a principle, and if the taxation of unrealised capital gains was to proceed, this would be contrary to most of our tax system, and it would set a very worrying precedent. Our position is we do not support it, but if the government is to proceed with taxing unrealised gains for this particular measure, then it should be overtly confined to this measure and not used for any other throughout the tax law. There are inherent issues where, what if someone pays the additional tax on an unrealised gain and then they pass away? We've got the inherent problem that if there is tax paid on an unrealised gain in 1 year and then a loss is made the following year, unrealised, the loss will be able to be carried forward to be offset against future unrealised gains and other earnings, presumably, but it's not going to be able to be carried back against the tax you've already paid. And this is a suggestion that we've put to Treasury, that they should at least allow later unrealised losses to be carried back in a similar way to loss carryback for corporate tax entities, so that some of that prior tax could be recouped. So this is a big area. We wait to see the final position of what the legislation is going to look like when it's introduced into Parliament. And of course, it still needs to be passed by both houses. So consultation is key to making sure this measure does operate as intended. In our links, you can see access through to the consultation paper released by Treasury, as well as the Tax Institute's submission on these measures. This is an example to date how the measure has emerged from consultation and will continue to, and we hope that the final landing place is a set of reasonable provisions. Moving on to what I consider one of the most significant changes which we will see in our superannuation system. and that is payday super. Under this measure, from 1 July 2026, employers will need to pay their superannuation guarantee contributions at the same time as they pay their salary and wages. Now, they have already indicated, as in the government, that there will need to be consequential changes to the SG charge. Now, this is essential. Imagine you've got someone on weekly payroll and they pay their super 1 day late each week. To face an SG charge 4 times in a month, the Part 7 penalty for potentially failing to lodge a statement on time would be unreasonable. We've also got the issue that currently, of course, there's a 28-day period after the end of the quarter to pay the super. Otherwise, the charge is imposed. And then there's a further 28 days into the second month following the end of the quarter to lodge the SG statement and pay the charge. How will this 28-day deadline work when you've, say, got weekly payroll? So all of this is going to require a rethink. It's a wonderful opportunity to redesign these rules. They are draconian, they are onerous for employers who pay just 1 day late, and these employers are treated the same way as an employer who never pays the super. So we know that the government is going to consult with stakeholders on the design of these changes, and the final design will be considered as part of the 24-25 federal budget. Now, consultation, as I've said, is going to be essential on this, and we're going to need every minute between now and the start date of 1 July 2026 to consult with stakeholders. Of course, there will be the large APRA regulated funds, there will be the self-managed sector, there will be payroll providers, there will be the digital service providers, the clearing houses, and then of course you've got employers and employees who need to understand these changes. It would not surprise me if many employers who are on weekly or fortnightly payrolls consider moving to monthly, but they will also need to consider any legal constraints. There may be impediments under, say, awards or enterprise agreements or even industrial law. Maybe they can't, in that particular award, move to a fortnightly or a monthly payroll. So all of this will need to be considered. But we know the SG charge is archaic and unfair, a 200% penalty for not paying super on time. There's no such penalty in the Fair Work Act for not paying wages on time. It discourages employers from addressing historical shortfalls where they're voluntarily addressing them. And also, we need to understand how we can improve these systemic issues and improve the system for everyone. Paramount is securing employee super, but it's got to be workable for employers as well. And for the best part of 30 years, these rules have been terribly unfair to employers. So we do wait to see what the consultation brings, but there will be significant changes for employers. Some have over the years embraced the idea of possibly having payday super. Others have balked at the thought and the impact on their cash flow. So regardless, we wait to see what consultation brings in the final form of these measures. On to the SME measures, and there are quite a few that are aimed at supporting this sector during these economically challenging times. So I'm going to spend a bit of time on the temporary instant asset write-off. I know this is of great interest to many of you, and yet again, since 2015, we have another change to these rules, just when we thought they were coming to an end on the 30th of June this year, with the ending of the temporary full expensing regime. So let me go through the measure first, and then we'll run through some thoughts and other ideas that come from this. Firstly, the instant asset threshold, in terms of writing off an asset, will be temporarily increased to $20,000 for eligible depreciable assets, which are first used or first installed ready for use from 1 July 2023 to 30 June 2024. Now, I'm going to latch onto that word increased. Many of you are going to say, well, hold on, isn't this a decrease? I want to say first up that if any of you are thinking this is a decrease from $150,000 to $20,000, please remember that that threshold ended for assets acquired by 31 December 2020. We haven't had a threshold in place for some years. Instead, we've had temporary full expensing, which enables the business to write off in full the asset if their turnover is under $5 billion, but there is no threshold on the cost of the asset. So in one sense, we could say it's not an increase to $20,000, it's a decrease from an unlimited threshold down to $20,000. But the reason the government's framed it in this manner is that all the way through this period, since 2015, when it went from $1,000 up to $20,000, and then it went to 25 and 30 and so on, the $1,000 threshold has remained in the law all this time. So in other words, you write off an asset under $1,000 when you're a small business entity and you choose to use the simplified depreciation rules. That threshold is in section 328(180) of the 97 Tax Act. But since 2015, that provision has been suspended. And instead, we've been dealing with section 328(180) and 328(181) in the Income Tax Transitional Provisions Act of 1997. So when the government says they're increasing it to 20, we would have reverted back to $1,000 from 1 July this year with the ending of the temporary full expensing regime. So therefore, the government is increasing it from $1,000 to $20,000 temporarily for 1 year. Now, you will need to be a small business entity, so an aggregated turnover of less than $10 million. They are telling us that this will apply on a per asset basis, which is consistent with how this is applied for the last few years. And therefore you'll be able to write off multiple assets instantly. I interpret that to mean even if it is a similar or an identical asset to another one, that in total could take you over the threshold. This differs from the $300 rule for employees and non-business investors, for example, rental properties, where the $300 rule applies on a grouping basis. So in other words, if you buy similar or identical assets, together they must cost less than $300. So that rule is not expected to apply here. You will be able to write off multiple assets as long as the asset individually is less than 20. Now, I've heard already some misconceptions that you'll be able to write off the first $20,000 of any asset and then pull the balance of the cost. This is not how I interpret the measure at all. The budget papers clearly state that the cost of the asset must be under $20,000, and that's GST exclusive. If the asset costs $20,000 or more, then the asset will need to be pulled into a general use pool. Now, I don't expect too many of you at the moment will have any pool balances at the moment, because for the last 2-3 years, you've had to fully deduct the pool balance at the end of June 30, 21, 22, and 23. So you're going to have to reacquaint yourselves with those rules. I've run some webinars of late on these particular measures, and more than likely we will do so again. So look out for those. Now, in terms of your pool balance, I would also expect that section 328(210) will be modified. And that would, at the moment, say if your pool balance is under $1,000, you must write it off. I would expect that if the pool balance is under $20,000 next year, you would have to write it off. So that becomes interesting when you've added assets into the pool that year, but then at the end of the year, your pool balance is under 20. And that could be because you've sold an asset and the termination value comes off the pool balance. So you'll need to refamiliarize yourself with all these rules. Now, in terms of the 5-year lockout rule, they will again defer that for a further 12 months. So if you've made a choice to exit the rules, then you're not subject to that lockout rule until after June 30, 2024. Finally, for larger businesses, and I'm referring to any business with an aggregated turnover of $10 million or more. So that'll go right up to, for example, the 50 mil or the 100 mil or whatever. These businesses will not have any immediate deduction available from 1 July this year. Temporary full expensing ends. They will not be able to access this $20,000 write-off because that will be confined to small business entities. So anyone who's $10 million or more will have to use the normal depreciation rules and depreciate over time. The only offering, and this is not legislative based, it's an ATO administrative approach in a practice statement. The number is PSLA 2003 number 8, It deals with low-cost business assets that cost up to $100 GST inclusive. So in other words, no more than $90.91 when you take out the input tax credit. Look, that'll allow you to write off the stapler or something very minor. But as far as anything more substantial than $90, larger businesses will have to go back to normal depreciation rules. There may well be some questions that arise out of this discussion, so feel free to pop those into the Q&A and we'll do our best to address them at the end. Now, this table may be familiar to some of you. I have used it for some years, but I keep updating it. That sets out for you all the relevant dates, the size of the business, the asset cost, and when the asset must be first used or installed ready for use. Now, in terms of the change that we're seeing in the budget, you'll see here we're awaiting detail of when the asset must be acquired or first held. I'm assuming that will be consistent with the budget measure, that is 1 July 23 to 30 June 2024. But what we do know is that this is the period where the asset must be first used or first installed ready for use. And we know that the asset must cost under $20,000. After June 30, 2024, without further legislative amendment, which is always possible with these provisions, I would expect that threshold to revert to the currently legislated 1,000 limit, which has been temporarily suspended and superseded by the transitional provision. Now, in terms of our position on these rules, we do support the measure. It is something that is clearly attractive to the government and they're certainly being used by businesses. So why do they keep drip feeding it year by year by year? Well, perhaps it's a political carrot to dangle where here's something else we can announce in the budget. While we support the measure, we would much prefer to see this as a permanent measure. And that would provide certainty, it would provide consistency, it would give businesses the knowledge of what the law says so they can plan and make decisions without having to rush out before the end of June to get full expensing if you're a larger business, without rushing a decision or delaying a decision. If we just had consistent provisions, it would operate much more efficiently. All right, another measure for small businesses. We have a third boost. So this one is called the Small Business Energy Incentive, and it will provide an additional 20% deduction to small and medium businesses to reduce their energy bills by electrifying assets and improving energy efficiency. So the turnover needs to be under $50 million, and the extra 20% deduction is based on the cost of eligible depreciating assets that support electrification, good word that one, and efficient energy usage. So this could be energy efficient fridges, it could be heating pumps, electric heating or cooling systems. Certain assets such as electric vehicles and renewable energy generation will not be eligible. There'll be a maximum deduction of $20,000, and this is based on a maximum expenditure of $100,000 that will be eligible. Now, the eligible assets or upgrades must be first used or first installed ready for use from 1 July this year to 30 June next year. We are again expecting to see some consultation on this particular measure. And I want to add that while we're waiting for this one to be formulated in law, we are still awaiting the passage of the other two boosts. So this is the Skills and Training Boost and the Technology Investment Boost. Both of these are sitting in the Treasury Laws Amendment 2022 Measures Number 4 Bill, which is currently before the Senate. Now, this is even more concerning because the Technology Investment Boost ends in 6 weeks. It's been running supposedly since budget last year, and that was May, of course, and yet we're still waiting for this particular measure to be legislated. So we support measures that encourage businesses to go out and invest in operations and sustainability, but we also need to legislate them promptly. If they're not legislated quickly, then you have uncertainty, and then businesses will hold off making these important investment decisions, which completely undermines the purpose of the measure. So just to summarize all that again, the two earlier proposed boosts, the Skills and Training Boost and the Investment Boost for Technology, yet to be legislated, but currently before the Senate. And this third boost is still to be legislated. So in terms of timing, technology investment boost is supposed to run out June 30 this year. The skills and training boost will run for 2 and a bit years, ending June 30, 2024. And this new third boost, the small business energy incentive, will run till June 30 next year. I also want to make mention of an energy bill incentive, I'm going to call it, which is a $650 payment that the government announced for small businesses. We're yet to understand exactly what a small business is. I'm assuming it's a $10 million threshold, not a $50 million threshold. We're yet to understand how it will be paid. All the government has said in the budget papers is that this $650 payment, and I add, it is up to $650. So how's it going to be phased in terms of the dollar amount? We don't know that yet either. It's going to be done in partnership with the state and territory governments. So it's unclear whether the government will make a payment directly to the state or territory government, which would then be used to take off the electricity bill, or whether the payment's going to be made to the business and they can then use it to reduce their bill. My thinking is more the former, because if it went straight to the business, then there's no guarantee it would be used to reduce electricity bills, or whether it's just a general incentive payment. So lots of questions on that $650 electricity bill reduction payment, and we wait to see more detail on that. Now, a measure that will assist the cash flow of small businesses and individuals that have an aggregated turnover of up to $10 million for GST instalments and $50 million for PAYG instalments. On those thresholds, the budget paper said up to $10 and $50 million respectively. I'd be expecting that would be less than 10 mil and less than 50 mil respectively. Now, this is about the GDP adjustment factor, the uplift for PAYG and GST instalments. The uplift is normally 12%, but instead for the 23-24 income year, the uplift will be just 6%. So this is a good measure. It will assist with the cash flow of businesses who may be struggling during these times, but it doesn't alter ultimately the amount of tax. It's just the timing of when it's paid, and there may be a little bit more tax to pay on lodgement depending on the final tax position, but it certainly allows less tax to be paid during the year. This measure has been introduced into Parliament, and it's contained within Schedule 4 to the Treasury Laws Amendment 2023 Measures Number 2 Bill. Now, in terms of corporate tax and international, given the audience that I'm speaking to today, and given our time constraints, there are a number of hidden slides that deal with changes to Part 4A and the Petroleum Resource Rent Tax. I felt that these probably weren't top of your priority list, so there's certainly information in the slide pack when you receive that, but I'm going to jump over those now. And the next measure I'd like to discuss is the electric car discount. Now, this has been in place since the beginning of the FBT year, beginning 1 April 2022. There is a 3-year period at the moment, and then after 3 years, the government's going to review the measure. But what they've announced in this year's budget is that plug-in hybrid electric cars will no longer be eligible for the FBT exemption from 1 April 2025. So after a 3-year run, these types of vehicles will be removed from the FBT exemption altogether and will again be subject to FBT. Now, this makes sense given the government's objective of promoting electric vehicles. Hybrids aren't really within that goal because the fact they still use petrol as well as using the electric motor. So no surprises here, but this may impact some of your clients who are considering doing this over the next few years or might actually have one. Now, you'll notice that any arrangements involving these sorts of cars made from 1 July last year to 31 March 2025 will remain eligible for the discount. On to a range of tax administration measures. So we've got a series of funding announcements. The first one is that nearly $90 million is going to be provided to the ATO to extend what's called the Personal Income Tax Compliance Program. This will extend the program for a further 2 years from 1 July 2025 through to mid-2027. So we know the ATO's focus is on rental property claims. We are told both last year and this year that based on ATO data, 9 out of 10 income tax returns that are lodged by a tax agent that include a rental property have errors in them. It's quite a staggering figure, and there's no suggestion that any of this is being done recklessly or deliberately. It's a complex area. And of course, you need to get the right information from your client. You need to be asking the right questions. They need to be giving you the right answers. They need to be making disclosures about how they're using the property. And when you've got holiday rentals or part private use or properties that are not available for rent for the whole year, this is where we start getting into apportionment issues and uncertainty about what amount is able to be claimed, including mates rates, which can often come up and then you're still claiming 100% of the deductions. So do take extra care this year. It is a clear focus of the ATO, and it is expected that they will be scrutinising these returns more closely than ever. CGT is also a focus of the ATO, and things like cryptocurrency, shares and property will continue to be a focus. We all know that when you switch one lot of shares for another lot of shares, that creates a CGT event. The same runs with cryptocurrency. So your Mo clients may think they're not cashing out any crypto and all they've done is switch one lot for another, but in tax terms, it does create a CGT event, and CGT may well be payable on any gain that is made. We also know the ATO is continuing to focus on work-related expenses, including those working from home. We've got the new set rate, the fixed rate of 67 cents an hour. For me to explain this at a technical level, please understand that this is not a rate that is prescribed by the ATO. They do not have the power under the law to prescribe a fixed rate for those working from home, unlike the power they have in the law for the set rate per kilometre for car expenses. That's because the legislation, Division 28, specifically allows the Commissioner to set a rate in claiming car expenses. But there is no equivalent for working from home. It's just an 8-1 expense. So the approach the Commissioner has taken is to use a practical compliance guideline. The number is 2023/1, where the ATO said they will not devote compliance resources to those who claim a deduction for working from home based on 67 cents an hour. It's legally a different approach. Now, importantly, the ATO said you will need to keep a record of actual hours worked from the 1st of March this year. And I acknowledge that we're halfway through May. This is a month and a half on, 2.5 months on. But please ensure your clients have records of actual hours worked from the 1st of March onwards. From the period 1 July last year through to the 28th of February this year, the ATO will accept a representative record. That actual hours are needed, otherwise you'll not be able to claim using the 67 cents an hour, and the client will need to default back to the actual cost method, which requires actual records anyway. Just for those of you who may be interested, I was interviewed by Channel 9 yesterday, and that played in Sydney and I believe Adelaide, in talking about these exact issues. So feel free to follow that up on your various media links if you're interested. All right, the GST compliance program. We have a 4-year extension of this program. Nearly $590 million will be provided over 4 years to the ATO from 1 July 2023. Now, this is about addressing the GST gap. And of course, we have lots of tax gaps that are issued by the ATO. The tax gap being the difference between the amount they think they should collect if everybody complied with the law and the amount they're actually collecting. Now, the gaps range. We have a multinational gap of around 4%. We have an FBT gap of around 22%, which is the worst of all of them. The net GST gap for 2021 is 5.9%, but they still would like to see that come down. And so these compliance resources being given to the ATO will enable them to ensure that people are correctly meeting their GST obligations and will allow them to develop some further analytical tools. We've also got a merging from 1 July 2023 of two programs dealing with serious crime. There's the Serious Financial Crime Task Force and the Serious Organised Crime Program. And both of these are going to be merged and will be extended for a further 4 years. Now, all of these measures are about funding, and we support funding for these agencies so they can do their job. However, it is really important that funding is diverted to ensure we have a better tax system and not merely for compliance programs and audits and task forces. The government's been taking this approach for many, many years of both sides of politics. Is there a better way that funding could be provided? We wholly support permanent funding over temporary funding. It's a little bit like a casual worker versus a permanent full-time. The casual worker is always wondering when their next shift is and when the next lot of pay is coming through. The permanent full-time worker knows when their next pay is coming through and how much it's going to be. And the same goes with these government agencies. If they have certainty, knowing when funding is going to be provided, then they can design their resourcing needs around that available funding to make sure that their activities are being designed properly. This idea of drip feeding funding, we'll give it to you for another 2 years and another 3 years and then another 2 years. We do think there is a better way of providing funding to these agencies. Now, small businesses, in terms of complying with their tax obligations, there are some improvements here. Now, I'm going to call them improvements because that's how the government's described them, but I've got my own thoughts on this. Firstly, there's going to be around $21 million provided to the ATO to reduce administrative burdens. One of them is streamlining the way that businesses authorise their tax agents and BAS agents to lodge multiple single-touch payroll forms. Now, I've got to look at this measure and say, let's not overdress this. For the past year or so, the government has already streamlined this process, and clients have been able to authorise their registered agent to act on their behalf using a written agreement called an STP engagement authority. Now, this stems from the requirement in the Tax Agent Services Act and the accompanying regulations that whenever an agent lodges something with the ATO on behalf of their client, they have to get the client's authorisation. If you're talking about an income tax return once a year, this isn't a problem. When you're talking about a weekly payroll report for STP, this becomes an onerous burden. And that's why the ATO, as an administrative approach, has allowed this STP engagement authority so that it can last for up to 12 months, and the employer only needs to authorise their agent once a year instead of for every pay event. So when the government says they're going to permit small businesses to authorise their agents to lodge multiple STP reports, and this is going to reduce your compliance burden, all this measure is really doing is formalising in what I think will be a tacit amendment or a regulation amendment to reflect what is already happening in practice. So my view is you're not going to see any discernible change here other than reflecting what we're already doing in practice. Now, there'll be reduced use of cheques, so more electronic banking, but this next one intrigues me as well. The government will allow small businesses up to 4 years to amend their income tax returns. This one interests me because from 1 July 2021, the law was amended to allow medium businesses, that is those under 50 million turnover, to be subject to a 2-year amendment period. But now the government is proposing that small business entities, those presumably under 10 million turnover, will have a 4-year amendment period. So how's it going to work with those under 10 mil being on a 4-year period, those being 10 million to less than 50 million being on a 2-year period, and those 50 million turnover and above also on 4 years? That strikes me as odd. We also don't know whether this is a one-way street, whether this is just giving 4 years to the business to allow them to amend their return to perhaps correct a deduction that was either under or overclaimed voluntarily. Or is this also going to allow the ATO to come back and amend within 4 years instead of 2? So lots of questions on this measure, and we will understand more when further detail is released. And of course, there's going to be funding to enable these measures to proceed. In terms of the timing of the payment of super and tax liabilities, we're going to see $82 million given to the government and the ATO over 4 years so they can address the growth in these debts. Now, we know that during COVID, a lot of businesses and tax practitioners fell behind in their lodgements. Completely understandable, and some are still trying to catch up. So the main focus of this measure will be an amnesty. And what it will do is allow taxpayers to become compliant by bringing up to date outstanding lodgements. Now, there are 2 periods that you need to note here. Firstly, you will need to lodge the outstanding statement between 1 June this year and 31 December this year. And already questions are being asked, can we have this brought forward? In other words, why wait till the 1st of June to lodge? Some may be ready to lodge now, but presumably wouldn't be eligible for the amnesty because it would be lodged prior to the 1st of June. So let's see where that starting date lands. Secondly, the statement itself must have been due for lodgement from the 1st of December 19 through to the 29th of February 2022. So this is clearly targeting statements that fell behind during the pandemic period. Third point, the amnesty relates to failure to lodge penalties. Now, what will happen is if you lodge a statement during the prescribed period that was due from December 19 to February 2022, the ATO will automatically remit the failure to lodge penalty. You will not have to apply for this. There's no form to complete. The ATO system will recognise at their end that you fall within the parameters and the penalty will be automatically remitted. All right, very quickly, some other measures that I would like to whiz through in the couple of minutes I've got left. So, announced but unenacted measures. We call these ABUMs. Firstly, the government has confirmed that the start date of the measure regarding frank distributions funded by capital raisings will be revised from December 2016 to September 2022. We already knew this. It's in a bill before Parliament at the moment that contains the revised date, so there was nothing new here. Secondly, the government has confirmed that 3 proposed patent box measures, these were announced in the 21-22 and 22-23 federal budget last year and the year before, will not proceed. Now, there's no particular surprise to those who are following these measures. In terms of the rest of the announced but unenacted measures, there was silence. So what's more important here is what not was said than what was said. So in other words, we are still waiting for dozens upon dozens of measures. We are waiting to understand what they're going to do with corporate tax residency. These changes were announced in 2020 and 2021. They were welcomed by industry, but still they have not proceeded to law. Division 7A continues to be proposed measures, and yet still nothing from Treasury since the consultation paper in 2018. Individual tax residency measures also proposed, and yet we haven't seen anything introduced into Parliament. Now, particularly with Division 7A and the individual tax measures for residency, we need to be very careful what we wish for. Don't wish for legislative reform just because the government said they're going to be doing it. We don't want measures that are more complicated or worse than what we've got, and further consultation is essential on both of those measures in particular. So we want to see all of this progressed. We want to see all these outstanding measures either abandoned, proceeding, but we can't just remain in limbo for years on end without knowing whether measures are going to proceed, particularly when by the time they are enacted, they become retrospective. The AAT is going to be reformed and replaced with a new administrative body. I won't go into any detail on this one, but you can see lots of funding over the years ahead. And this is certainly an opportunity to improve all of these aspects of the way that we resolve disputes. There's certainly merit in the way disputes can be resolved through the AAT. It is cheaper. It is certainly cheaper than going to the federal court, but at the same time, there can be substantial delays in getting disputes resolved. So we are part of the consultation on this and we're giving our thoughts. We hope to see an improvement on the current system. Build to rent. This is about a series of measures which are going to encourage supposedly the building of more social housing. The issue is that the conditions of having to build at least 50 apartments, owning the apartments for at least 10 years before you sell them, and also having a 3-year minimum lease may well be unattractive. And so it's going to be interesting to see how many investors come forward to support this measure, and also whether they are primarily from overseas or whether they are domestic investors. There are also changes to the withholding rate for managed investment trusts, both for the build to rent program and also the clean building concessions. I'll leave the detail with you in that slide. And finally, social impact investing, which very broadly is about targeting funding to deeply ingrained social issues. So there could be disadvantaged communities, could be education, disability care, aged care, homelessness, employment, but a fund will be set up and it's going to enable this to progress and support all of these social particular issues. Certainly it's been running in the UK for many years. It's a well-oiled machine over there. And it will be interesting to see whether the UK model, whether any of that is embraced in designing our Australian system. So on that note, Grant, I'm sure some questions have come through. I know you've got a few more messages. I shall hand back to you.
Amazing. Thanks so much, Robyn. Let me just quickly share my screen. Brilliant. Robyn, thanks a lot. There was obviously a lot to take in there, a lot to unpack for your clients, and obviously we're also heading into the busy period. So I just want to take a couple of minutes to quickly highlight a couple of key tools in the QuickBooks suite that can really help you streamline your processes for end of year. The QuickBooks suite is where your practice comes together. For your client accounting, you've got QuickBooks Online that lets you collaborate with your clients by accessing the same data, the same system, and the same view at the same time. QuickBooks Online Accountant then lets you manage your clients, lets you track all your jobs, record where you're spending your time, send out your fixed fees, manage invoices, pay your team, even manage your own books. QuickBooks Tax, as I mentioned at the start of the show, is powered by LodgeiT, and it streamlines your tax and BAS preparation and lodgement workflow with really powerful integrations and automations. And finally, you've got QuickBooks Payroll that's powered by Employment Hero just to keep your clients compliant and make payroll a breeze. Let's take a really quick look at a couple of key features though. For the accountants and tax agents on the call, Prep for Taxes, if you're not using it, this is the one to take a look at this afternoon after the webinar. It's really going to ease the pressure of end of financial year by organising and tracking your clients' accounts all in one place. You can track your team's progress and you can see when each account has been prepared and reviewed. You've got a filterable trial balance timeline that displays client and accountant activities that are impacting balances, and you can drill down to make adjustments to transaction details. You can also add notes and attach documents that will only be visible to you and your firm. Now, the importance of standardising your processes can't be overestimated, and Prep for Taxes lets you build a step-by-step process for lodgements based on how you and your team work. The Documents tab houses and lets you view source documents that have been added to accounts by yourself or by team members throughout the year with annotations that can only be seen by your team. The section makes reviewing your team's work a snap because everything's in one place and organised. A folder is automatically added to Prep for Taxes for each account, and you can create new folders individually or by using a template from another client. Once finalised, you can seamlessly transfer that data to the tax return in QuickBooks Tax powered by LodgeiT. QuickBooks Tax really just completes the final stage in your end-to-end tax and BAS workflows, letting you manage your tax and BAS compliance in a far more efficient and productive manner. It really can save you so much time this end of financial year. You've got automated working papers that help you reconcile accounts by month, quarter or year, an intuitive notification that lets you review which working papers have been completed and approved. There's built-in calculators that substantiate and validate a range of financial balances. And you've got business financial information dynamically pre-filled from QuickBooks Online, from all accounting systems actually, no matter which ones your client uses. So with automated filling of tax forms and with cross-filling for spouses, trust distributions, partnerships, dividends, investment income splits, and a whole lot more, it helps you reduce turnaround times. You've got an electronic form submission and sign-off so that your clients can easily return them. And QuickBooks Pro Advisor program members not only get free access to QuickBooks Tax, but they also get unlimited e-signatures to really speed up those turnaround times. Then, once you're done, you can lodge your tax returns and your BAS returns direct to the ATO. The great thing about QuickBooks Tax is it's included in the QuickBooks Pro Advisor program. It's free to join, and even better, as I mentioned, it is an agnostic solution. So you can import your client's data from MYOB, from Xero, from any solution that you're using. It's really is a game changer for your tax and VAS lodgements. Jump onto that QR code on screen or visit intuit.me/QB tax time to find out more about it and how you can unlock free access today. Now, for a look at those tools, as well as more tips on streamlining your processes, make sure that you download our latest ebook. It goes into a lot more depth on taking a proactive approach with your clients for end of financial year, how to ensure that your team is properly equipped, as well as how having the right tools in place makes end of financial year easier. It also includes a link to our updated end of financial year checklist, and you can grab that from that QR code on screen, or you can go to intuit.me/EOFY ebook. We will have a link to that in the follow-up email that we send with a recording of today's session as well. One last very quick thing. I'm assuming that most of you are already using QuickBooks Online with your clients, but are you aware of our firm ledger solution for your smaller clients who don't need access to their books? For your low trading clients, partnerships, trusts, SMSF returns. QuickBooks Firm Ledger combines with QuickBooks Tax to really streamline your compliance workflows and get those returns done quickly and incredibly cost effectively. We'd love to see you take advantage of the time savings that Firm Ledger can offer, and that's why for a limited time you can switch those smaller clients over to Firm Ledger and not only save 50%, but you can lock that discount in for 36 months. QuickBooks Tax, powered by LodgeiT, as I mentioned, is included as a benefit in the QuickBooks Pro Advisor program, free to join. And with free migration included, there's really never been a better time to make the switch. And what's more, as a thank you, once you've migrated those clients, we'll give you a $250 gift card. We do have a special offer for your other clients as well. If you purchase a bundle of 5 or more subscriptions, you'll save 50% on our exclusive Pro Advisor pricing, but you can lock that price in for 3 years. And look, everyone's facing cost of living pressures at the moment, your clients. The certainty that this offer delivers over the next 3 years could make a real difference. Again, migration is concluded for Essentials and Plus subscriptions. And again, as a thank you for switching, you'll receive a $250 gift card once you activate those subscriptions. Speak to your QuickBooks partner manager today for more information on both of those offers, or you can visit intuit.me/36 months. And again, we will have that link to those offers in an email coming out to you, so watch out for your inbox for those. Okay, we will jump in to some quick Q&A.
Grant, I've been answering some of them in the background while you've been talking, so that's dealt with a few of them.
Amazing.
But I can see one here about the stage 3 tax cuts, and I'd like to address that one briefly because I haven't talked about that.
Great, jump in.
The question is, should we expect the stage 3 tax cuts in 24-25 to be wound back? Look, this remains to be seen. The government has certainly continued its position and maintained its position that they are committed to delivering the already legislated cuts. And do bear in mind that if they're going to change them, they would need to amend the law to remove the tax cuts or change them. Look, we just don't know. It's a year away and there's a lot of water that needs to pass under the bridge between now and then. But the government, of course, will be battling with the economic conditions. We don't know what inflation is going to look like at that point. We don't know what the budget's going to look like at that point. And then we've also got the issue of so-called equity. Stages 1 and 2 have already gone through. And should there be further cuts allowed to the high income earners who there's a perception that they can afford it and shouldn't need tax cuts. So this debate will continue to play out there and we just wait and see.
Great, thanks, Robyn. One that we've got a slightly vested interest in is the technology investment boost. Has that passed?
No, so as I said in my presentation, that is still before the Senate. And the really worrying part of this is that it is due to end in just 6 weeks. So if businesses have been holding off for it to become law, Parliament is going to have limited sittings between now and June 30. It may be only a matter of weeks that we have law, and then we've got the measure expiring. So whether it never sees the light of day, whether they delay it by 12 months, there was no suggestion of that in the budget. So it's a bit unclear, but certainly if it wraps up in 6 weeks, it may not have had the run that was intended.
Thanks, Robyn. We had one quickly from Mitchell looking at the depreciation rules, and he's wondering what will happen to those on the 1st of July.
All right, so Mitchell, I hope that I answered all the questions relating to that issue during the presentation. But if not, go back to the section where I talked about the instant asset write-off. So essentially, and I'll summarize this very briefly, Grant, $20,000 instant asset write-off for those under $10 million aggregated turnover. The asset must cost less than $20,000, and that runs for 1 year only. Large businesses, anyone over 10 million, is going to have to use the normal depreciation rules. They will have no instant asset write-off. Most importantly, for all the practitioners out there, you're going to have to reacquaint yourselves with the pooling rules because you haven't used them for some years.
Great, thanks, Robyn. One last one we might touch on very quickly. I think it's a slightly rhetorical question on the FLT amnesty. And Mai was wondering, why does the initial due date end on the 29th of February? Who stops lodging and starts again with later obligations?
Look, it's an interesting one, and also why they've gone back to early December, because the pandemic really didn't hit till, I'm going to say March, but they could say January, February included, but it goes back to December of 2019, but stops on the 29th of February last year. They're interesting dates. I agree with the comment who stops lodging and then starts again. And with the amnesty period of starting 1 June this year, it means that if anyone actually wants to lodge now, they really should hold off for 2 weeks until the 1st of June to make sure they get the amnesty, because presumably if they lodge now, they wouldn't benefit from it. So that's also an odd one, which I highlighted in my discussion.
Awesome, thanks, Robyn. We are a couple of minutes over time, so we'll let everyone get back to their days. I'm sure everyone's very busy at the moment. Robyn, thank you so much for your time and presenting today. A lot of information to unpack there. As we've said, we will have the recording out to you by email, along with the slide pack that Robyn has presented, which contains a lot of links to further information and further reading. We'll have a link to our new ebook, as well as those offers I discussed. So for everyone on the call today, thank you so much for your time. Thank you for joining us, and we'll catch you at the next ProPower Hour. Thank you.